Hello, everyone. Welcome to the Money Talk. I'm Johnny.
And I am Theresa. And today we have with us Miss Linda GRIZELY, who is a certified financial planning, and she will be educating us today on financial planning. And today I would like to welcome Miss Linda. How are you?
I'm doing good. Thanks for having me.
Wonderful. Can you introduce yourself to the listeners, please?
Sure. So I'm Linda GRIZELY, as you said, grizzly like the grizzly bear, and I'm a certified financial planner. My company's name is Visions Financial Planning, and I help people with comprehensive financial planning, which is looking at all the aspects of their financial life, as well as their values and their personal life, taking into account their unique situations to figure out how they can move forward and save for retirement and save for college and buy houses and all the things that they want to do in their life.
Wonderful.
Nice. Well, I'm ready. Let's dive into it.
Okay, so my first question is, if we have someone wanting to get into investing, I know a lot of the financial experts say, well, you need to have your debt under control first before you look at investing. So I would like for you to educate our listeners on what they need to have in place to start investing.
So I don't have that same outlook. Obviously, paying off debt might be a good strategy to go with first. There's good debt and bad debt, so that's a whole nother conversation. But as far as investing goes, it's always good to start investing because you want to take advantage of the compounding interest and the compounding value of investing. Even if you're, investing in the stock market, we don't necessarily have interest paying out. Like, you want that long-term growth. So the sooner you get involved in saving and investing, the better. And you can do that alongside a plan for paying off debt.
Okay, so that's a good thing to have, because a lot of times in my mind, like if you have a lot of debt, it's going to take you a long time to get into the investing world if you spend most of your time getting out of debt.
That's true. And it's like I said, everybody has their uniqueness. And that's the good thing about financial planning, is that when you take everybody's individual circumstances, so there's not like a blanket thing where you can say, like, if you have a lot of debt, don't start saving anything. There might be an instance where I would say, yeah, let's hold off on saving anything until we can get you out of debt. But most importantly, even before investing, though, you want to be sure you have some sort of emergency fund set up. So that investing might look different, so that you might be investing in something that's more like a high yield savings account rather than getting into the stock market if you have a lot of debt, because you want to be sure you have padding in there to be available to you for any unexpected circumstances. So everybody's unique circumstances might play differently into where they're investing, how they're investing, and how much, right?
Yes. So you mentioned emergency fund. What would you recommend to listeners if they are meeting with a financial planner, and how many months of emergency fund would you recommend?
So it's 3 to 6 months of emergency fund that we recommend. We say 3 months if you have spouses that are both employed, so that if one of them were to lose their job, the other one would probably still be working. So that would be maybe a 3-month plan, 3 months of expenses. 6 months if you're single, or 6 months if one of you doesn't have a stable income, then you want to have 6 months available to you. Obviously, if you have more, that's good. The idea is that if something were to happen, and it's not even just losing your job, but it's maybe getting in an accident or having an injury or an illness that sets you out for a short-term disability type of thing, you want to be sure you have that cushion in there so that you're not struggling or ending up like in debt or having bad debt during a time when you're struggling with other things at the same time.
Okay.
Yeah, and I'm gonna add this to that. You mentioned good and bad debt. Could you kind of explain that to the audience? What's the difference between the two?
Sure. So bad debt would be credit cards and high interest, super high interest on those credit cards, amazingly high. And that's bad debt, because you're carrying that forward. And if you only pay your minimum payment on your credit cards, a lot of times, especially when it's higher balances, you're never going to get ahead, because you're just going to keep getting charged the interest that might even be more than your minimum payment. So that's bad debt, when you can be going backwards and having that high interest rate. Good debt would be things like, right now, if you have a mortgage on your house that maybe you had financed or refinanced during the low interest rate times. Let's say you're at 3%, whereas mortgage rates right now are at like 6.5, almost 7% right now. but you can actually invest in just a high yield savings account for 5%. So good debt right now is your mortgage if you're only paying 3%, but you can invest easily in a liquid account that has no risk to it, FDIC insured even for 5%. So that's a good type of debt.
Okay, perfect. And then this is something that I need to hear also for myself, where I can help some of my clients. When we talk about a financial plan, Linda, some of us may think, oh yeah, we got it going on. We got everything in order. Can you tell our listeners exactly what is a good financial plan? Like if someone came to you, you could say, oh, your financial plan is great. I just need to maintain you.
Yeah. So when I go through financial planning, it's a process. I follow the CFP board's process, but I get to know you personally because, like I said, that is a big part of putting together a plan, because what plan is going to work for you is not the same plan that's going to work for somebody else. You're going to have different values, different lifestyle, different people in your lives. But I look at all the aspects, meaning I look at your insurances. I'll have a review. I'm not a insurance person myself, but I'll have a review of any life insurance, annuities, your car, your home insurance, umbrella insurance. I'll have a review of that. I'll review tax returns for you. I look at literally everything that has to do with your finances to make sure that you're all in order. And yes, there are times when we would get to a point, or somebody might come in and I'd be like, wow, you have everything in order. But if anything changes in your life, if your financial situation changes, you change jobs, you have another child, you get married, you get divorced, whatever happens, that always changes the plan, because things are not the same. Your circumstances are not the same as they were.
Wonderful. Thank you for saying that, because based on what you're saying, your financial plan is more than just investing. You also need to have your insurance. You need to have your 3 to 6 months emergency fund. You need to get rid of really like the bad debt. So I just want our listeners to understand that a financial plan isn't just going to see a certified financial planner and say, oh, I'm going to invest in mutual funds or stocks. It's like an entire picture of your financial life.
Correct. Yeah. So some people think of a financial advisor as someone who just helps them with their investing. And that also, that's just a piece of what I do, though. The holistic comprehensive plan includes so much more than that.
I like that holistic word, the holistic plan.
Yes.
So now we probably do have like some younger listeners who may not be familiar with the word holistic. Can you explain holistic in the financial planning world?
Yeah, it means as a whole. So talking about all the pieces of your financial plan, your financial pieces, as well as you as a person, that to me is holistic. It's the whole being, the whole of your finances and you, and how that planning works for you. And I also want to say that it's not only figuring out what you have now and what your plan is now, but how that plays out in the future. So we start with figuring out where you are and help you understand all those pieces that you have and how they work together. And then we figure out where you're going, what your plan is, what your goals are, and how are you going to get to those goals.
Oh, that's beautiful.
Yes, that's nice.
Yeah. You want to add something to that?
No, I mean, what can you add to that? Because you're absolutely correct. When you're talking about the whole picture of somebody's finances, you want the whole thing, not part of it, but the whole aspect of the financial picture, so to help them along. So, Linda, so we're talking about holistically the financial picture, right? The whole thing. So what about, like, if you're working and you have the opportunity for like a 401k or a Roth RA or 457, whatever the case may be, what would your recommendations be to somebody who you probably would be advising on those particular type entities?
Right. So it's not going to be the same answer for every person. Again, it's totally individualized. So I have people that'll ask me, like, can you look at my 401k and can you help me just figure out where I need to invest it? And the quick answer is I have no idea where you need to invest it if I don't know more about you, because what the answer for you is not going to be the same as anybody else. But I do help them understand what that means, what the purpose is of each type of account. And there's something that's called, this kind of relates to what you were asking, but there's something that's called asset location, which talks about like what types of investments you have in what types of accounts. Like what types of investments should I put into my Roth, and what types of investments should I put into my regular IRA or my 401k? And how is that different from what I might be investing in a brokerage that's completely taxable account that's not in a retirement account? Like what investments should I put in which place? And that's another conversation that we have.
Okay, and so now that you're talking about that, I listened to some financial gurus on YouTube, and I'm not a certified financial planner, I'm a coach. So my question is, I hear a lot of the financial planners say, max out your 401k, and then once you do that, you can move over to a Roth or either traditional IRA. Can you explain to the listeners, like, what do you consider as being maxing out your retirement plan at work and then moving over to an IRA?
Or do you have a different perspective? Because you may have a different perspective. So
yeah, so as far as maxing out your 401k, I'm not sure who you were listening to or what part of it that they said, but to me, when I would say make sure you're getting the entire match that you can get. Not necessarily maxing out your contribution, but make sure you're at least getting that match, because that's free money. Like, that's free money to you. What better way to earn money than just to have somebody give you extra money because you're saving money? So the first thing I say is make sure you're getting whatever match that you can in your 401k. And then the conversation about whether to put it into the 401k or the Roth or an IRA is a whole separate conversation. So sometimes you can't put into both a 401k and an IRA. There's lots of tax rules around that. But the decision whether to put into a Roth or a deferred account. So for the listeners, then a Roth IRA is a tool that allows you to pay tax on your money as you earn it, but then put it into a retirement account that is going to earn money and be tax free eventually when you take it out. Whereas your 401k typically, or your IRA, which is an individual retirement account, those are what we call tax deferred, which means that you're not paying tax on that money when it goes in. So then you have to pay tax on the money when it comes out. And the difference is a strategy for taxation in the future. So that's a conversation that we have. And what are your taxes going to look like in the future? When you decide to take this money out, is your tax rate going to be lower or higher? And really, all we can do is have our best guess. But sometimes people have pensions or other things that are going to give them taxable income in retirement. So there might be a bigger reason to have a Roth rather than a traditional IRA or 401k. But that's like a whole tax conversation that goes into that holistic planning. And there's also sometimes different choices within your 401k. So there can be a deferred option or a Roth option, or even a way to put additional money in if you want to, that's outside of those limits. So that's another conversation too, but everybody has their own unique set of circumstances.
Okay, well, that was very good, very educational, because I didn't even think about asking you to explain what the Roth IRA was. And a lot of the listeners, especially the younger generation, if they didn't come from a family that talks about this or doesn't have someone in their lives to explain this, thank you for explaining what a Roth IRA is. That was great.
Sure.
So with that, I'm gonna dive in a little bit deeper on the 401ks and the Roth. And if you say, for instance, you are maybe like 65 or whatever the case may be, and you're thinking about retiring, right, from your job or whatever the case may be, and you said, okay, well, I have this money sitting over in this 401k, and I think I'm ready to start receiving some of the money out of the 401k. So now for taxes, how does that work? Would you recommend, if they were in that age range of retirement, would you say start drawing it out at an earlier age than 65 so you can maybe avoid tax penalty later? Or what would you recommend on something like that?
So it's going to depend on what their current earnings are. So there's going to be tax brackets involved, because every time that you take money out of a deferred account, whether it be IRA or 401k, you're going to pay tax on that as you take it out, and it becomes taxable to you. So it's going to be taxable income on your tax return when you file it. So if you're still working and you start taking money out of those retirement accounts, it can cause you to go up to another tax bracket because you're still working and all that. And even if you're not working, if you got to watch, you might need to watch your levels as you come out. There's there's another thing, because you mentioned the age of 65, but if you're on if you're on Medicare, right? So you're using Medicare, whether if you're working or not working, but Medicare also will end up having surcharges if you go over certain amounts of income in retirement. So that's another thing that people need to keep on their radar when they're retired, is making sure that they don't surge into a different income bracket for Medicare, and that's called the IRMA, IRMAA, I think. So it's called IRMA, and it's a surcharge on Medicare. It's not called a tax, but it just causes your premiums to go up if you're over a certain income limit.
Linda,
Did not know that.
Linda, did not know that. Did not know that. I hope that there's someone listening to you. If they're thinking about taking money out of their retirement account, they sure better know what they're doing, because then it's going to increase their Medicare bill.
Yeah.
I'm stunned. Well, thank you again for sharing that. I hope that there's someone that's listening that knows they better watch the amount that they take out.
Well, you don't think about that.
No. And they don't say that on TV. And they don't even tell you that really in your workplace, because I never heard that. So like once you start on Medicare, depending on how much you take from your retirement account, if it puts you in a higher tax bracket, there's a surcharge. And then this called IRMA. Is that correct? What you just, because I wrote that down so I can study it.
Yeah. And it's actually, it's not the same as tax brackets. There's actually IRMA brackets that you have to watch out for. So it's a whole separate table.
Okay, Linda, that you are brilliant. I didn't know that. So I know you've heard of Dave Ramsey, and like he recommends putting in like 15% of your income into investing for your retirement. Do you have a certain percentage that you recommend?
I don't, because I can't give a blanket recommendation, because it could cause somebody to have other issues. If I said blanket, everybody needs to put in 15%. I know nothing about that person. I don't know what their other bills are, what their debt is, what their tax situation is. So planning is super important as far as like figuring out what makes sense for you. That's all I'm going to say on that.
Because you know what, then it goes back to that holistic approach that you were discussing. So like we may have someone that say, well, okay, I better do 15%, but in reality, they can't really afford 15% right now. Or they could do a little bit more and they're not doing more because they're stuck, with the 15 or 20% in their mind.
Yeah.
I never looked at it like that. I'm kind of like one of these blanket people. So you're helping my mindset when it comes to a certain percentage of investing.
I mean, wow, Linda. I'm still stuck on the IRMA because I never heard that before. And it's kind of, I'm thinking in my mind, I need to do some research on that one because that was very beneficial for me.
Yeah, it will be beneficial for us in the future. So that was something that we needed to know. And then a lot of people, and then we are from the South, and a lot of people are like afraid of investing. What do you tell people about like their risk tolerance? Because I know that's part of your plan. You have to figure out what their risk tolerance is. Can we talk about that a little?
Absolutely. So your risk tolerance is usually there's a questionnaire that we give that helps us decide what your risk tolerance is. And you can be like, if you're really risk tolerant, then you're like on the high end of the scale. And that means like you're fine to just put money in the stock market. You might be buying individual stocks. You might be, just putting something in an S&P 500 fund and like let it ride. And you're going to have a lot of ebbs and flows. You're going to have really high highs and really low lows because you have a lot of risk going on. And then on the other end of the spectrum, you have somebody who's completely afraid to invest that has a really low risk tolerance, and they might just have things sitting in like a regular savings account, maybe not even a high yield savings account. Maybe they're not even interested in putting money into CDs. Like there could be like an extreme on one end and an extreme on the other end. But going through a risk tolerance questionnaire helps us understand where the client lies. Balanced would be in the middle. But your risk tolerance is also going to change over time with your age and with your circumstances. So someone who's younger, who's putting money into a 401k or a Roth, any type of retirement account, is going to be looking at it and saying, I'm not even allowed to touch this money until I'm 59 and a half. So I can afford to take risk and take highs and lows because it's going to be in there for a long time. But that risk that they're taking, they don't necessarily maybe want to take risk in something that might lose its loss, lose value completely. So there's still some safety measures that they might want to put in place because it's their retirement money, but they have a lot more risk because they have a lot longer time. But people, as they're approaching retirement age, generally want to start toning down on the risk, right?
Right.
And that's when we talk about in retirement, where we start talking about like, okay, if you've gained like this big amount of money and you have this mountain of money that you've gained and your whole life you've climbed up the mountain building that wealth. Now you have to figure out how to get down the mountain safely when you retire. Like, how am I going to get down? How am I going to make sure that, I come all the way down the mountain, I don't run out of money. And that's where you start like taking out that, right? And there's different strategies for that. So there's lots of different ways we can place, change your finances as you go to change as with your risk tolerance. But that's like the general concept. If you have any specific questions about that, would be great if you have any.
Yeah, well, that helped me a lot because a lot of people they're so afraid. But a good financial planner is going to assess your risk tolerance and not going to put you into anything that's going to make you lose sleep.
Yeah.
Forever.
Exactly. Right. So, as a financial planner, we all have our own like risk tolerance ourselves, right? Some of us are, even as financial planners, some of us have higher risk, some of us has lower risk. And I try very hard not to take my belief in that and put it onto my client. I really try to focus on like what theirs is. But a lot of times if they're really low risk and I feel like they need to take more risk, I can explain things and we can like compromise and say, okay, would it make you feel better putting more risk in, say, this particular account if you know that this account is fully secure? If we do some CDs here that are FDIC insured and have like a guaranteed interest rate, and right now we have that opportunity. That's a good thing about having high interest rates, is that you can actually invest in something that's stable in a higher interest rate. We didn't have that for quite a few years, but then maybe they'd be more willing to take some risk somewhere else, and say like, okay, let's put a little bit into here and let's find a fund that works for me or something.
Okay, now the younger generation may not know about FDIC. Can you just explain what that is?
So there's different types of insurance on your money, right? So money that's invested in banks is Federal Deposit Insurance Corporation. I think it's corporation. Is the company that insures your money when it's in a federal bank, right? Any bank that's like a regular bank, that's FDIC insured. And then there's also CDs and things that are not FDIC insured, but they're market CDs, and also the other market, and those are usually covered by like SIPC insurance, which is securities, blah blah blah, and that depends on where you have it invested, as to what type of coverage that they have. So it's not saying that you're not going to lose money. It's saying that you're insured against different types of things. I don't want to go too deep into that, but it's not saying that you're not going to lose money if you're invested in the stock market, obviously, but it's saying that you're going to be protected against that institution that you're in.
Okay, that makes sense. Thanks.
Yes. So college. So we know that sometimes we have children, want to go to college when they graduate high school. What do you think about 529? And then what other option would you recommend for like saving for college?
Gosh, that's a deep conversation. So, 529s are a great tool. But they have times when they're not a great tool, right? Because
we
know
they are limited into what they can do. And usually when people start planning with a 529, the children are young and they really don't know what those children are going to be like when they're older. Are they going to get a scholarship? Are they going to be like, I am never going to college? Like, how are they going to be? We really don't know. So it's really a deeper conversation with the parents, grandparents, whoever happens to be funding this 529. But it can be a great tool when used properly.
Right. Well, you know what? If we can just talk maybe a minute or 30 seconds because what you have said is exactly true. You may
Yes.
have a child, oh, wonderful that they got a scholarship, but maybe you put this money into this 529 because when they were babies, you were thinking, oh, they're going to be doctors, oh, they're going to get their masters.
Oh,
So when we have these visions for our children with these 529s, parents and grandparents do need to understand if they don't use this money for college, when you remove this money, you have to pay a tax penalty, right? Is that correct, Linda?
That's correct. There are some ways that you can move the money. It can be moved from one child to another. There's also some new options that came about in converting it to a Roth, but there's a lot of details that go into deciding whether that can happen or not. But there are some things that you can do. And then, it's still, even if you're paying a penalty, sometimes if that's what you need to do and you need to take it out of there, it's really, it's a hard punch to the stomach, but in reality, still necessarily might not be like it was a horrible bad decision. It could still have been a good decision. But that's one of those things where it's like we can't predict the future. Even when we do tax planning for the future, we really don't know what that's going to look like no matter what. Right. All we can do is just do our best. And I think that's what parenting is, just doing your best in the space that you're in and hoping for the best for the future, but knowing that there's going to be all kinds of like turns in the road and roadblocks and U-turns and forks and everything that happens in parenting.
Oh, yeah. Yes. And then I know about the 529 and there's an UTMA. Do you recommend like other options to save for college? Like the one of them, I don't know if it's the UTMA or the uniform gift. Like it belongs to that child when they turn, I think 18 or 21.
Yeah, that's going to vary state by state, I think, as to who it belongs to, or not who it belongs to, who it went at what time they have the age of majority. Yeah, there's a lot of in college planning. There's that like thinking about like what's going to be counted, because the children's assets count more than the parents' assets do when it comes to college planning. So college planning can get like super complicated. So it's hard to say like without talking to a specific set of parents about a specific child or children and saying what's going to make the most sense for them.
Okay. Well, thank you for that information.
So that was great.
But I appreciate your honesty, because like a lot of parents, like when we were young and you first have your child,
yes,
like you hope for the best, but then you still don't really leave room for error. And so I think it's so important and so honorable that you really spoke the truth in saying, well, they could get a scholarship or they could just be like, I'm never going to college. So I'm hoping that a listener is listening to this and realize you can hope for it, but that's not guaranteed that there's not going to be forks in the road when it comes to these savings plans.
Forks, dips, rocks.
Yeah, I like that.
Valleys.
Yeah. So and having that conversation as to whether or not to start a 529, that's part of the conversation that I have is like, you have to know that if this isn't used the right way, that this is going to be like the consequence or the circumstance that's going to happen in the end. And sometimes they're like, I'm willing to take that chance. And that makes sense, because the pros of it, if it does work out, are going to be fantastic. Right. So yeah. So a lot of times they'll say, yeah, let's do it anyway. But sometimes they'll say, and this goes back to like the person's own risk tolerance too. Like, do I want to have that risk that might happen at the end? What are going to be my options? And really, honestly, we don't know what the options are going to be at the end, because they just added something new last year. So maybe they'll add something new in the future too, that will allow us to do something else with that money if it's not used for college. So.
Okay. Well, that's good to know.
So if you don't go to 529 route, what route would you recommend if you didn't go to 529 route?
So that's a really hard question to answer with that. And I know I keep going back to that, but it really is hard to answer like without knowing somebody's specific circumstance. I mean, I would say just any type of savings plan, right? Get something invested, something saved. So that you're not like scrambling at the last minute to figure out how your kid's going to go to college. Right.
Perfect. Yes.
And remember that if you do that, do a uniform gift, like the UTMA into a child's name, it is theirs. as soon as they reach the age of majority, and they can do whatever they want with it. So yeah, there's different strategies around that too, right?
See, you did answer that question.
Yeah.
Say something, because there's so many
Yeah.
children, well, students now that have to get student loans because the parents didn't do anything. So like you said, even if it's not a 529, save something.
Yeah.
So
yeah.
you answered that question perfectly. Thank you.
So you know me, I got another question because I'm going to the market now. So you invested in the market, and the market is doing good for a few years, and all of a sudden it dropped. What do you do? I mean, do you take your money out? Do you leave it in? What would you do?
So this comes to my personal belief in market efficiency. And I believe that the markets are basically efficient. And that if you are set up in a proper portfolio for where you are and where you want to go, that you should leave it in there. I'm a set it and forget it type of investor for my clients. I'm very upfront with that. I'm not an active trader. And when I say set it and forget it, I don't literally mean forget it, because we're still going to rebalance. We're still going to do what's called tax loss harvesting if it's in a taxable account, which is offsetting losses and gains so that you can take advantage of taxes, but that's a whole nother story. And then, we do maintenance on the account. So it's really not set and forget. We are not forgetting it, but we're staying true to our investment strategy. And it should be set up, like I said, you're going to have, as you're approaching retirement or approaching the time that you're going to need whatever account is that you're talking about, then your risk should be less and less. So you should have less ups and downs, right? So I talked about retirement, but let's say that you're younger and you're just saving for a house and you're trying to put money aside to save for a house. You want to, or any other big purchase, right? You're not going to have that in a high risk, because you don't want to take the risk of losing it, because your time frame is shorter. So you're going to have it in less risk. So your roller coaster is going to be really small. Whereas like if you're investing for retirement and retirement's 20 years off and the market goes down, you might have a huge dip, but you have 20 years to make up for it. So it's not going to be as big of a deal. But as you get closer to the time you're going to use that money, whether it be buying something or retirement or college, whatever it is, as you get closer to that time period, you're going to be reducing the risk in that account.
Okay, perfect. And then I only have a couple more questions. And this question is, how do people interview and choose a financial planner? What qualities should that financial planner have? Because also too, nowadays, people are a little afraid to hire financial planners because they're afraid that their money will get stolen, or they may not know how to interview a financial planner. Can you give some recommendations to our listeners as to the things that they should look for in a financial planner?
Of course, yes. So I think the most important thing is rapport, and knowing that your planner or your person is listening to you. You need to feel heard. If you don't feel heard, you're not in the right spot. You need to find somebody else. If you don't feel like you're being heard, they're talking over you, or if they're talking in terms that you don't understand, then you're not in the right place. You should find somebody else. The other thing is that you should understand how they get paid. So there's all different types of financial planners or advisors. There's some that get paid on commission only. And usually those are like insurance people, where they're just selling insurance. So they get commission only, and they don't really have a duty to you. They are just selling products. So it may or may not be a good product for you, but you don't really know that for sure. Then you have people that are advisors or planners who are fee-based, and they can earn. So fee-based means you can earn a commission. You can sell a product and earn a commission. You can charge a percentage of assets under management. So you can have assets that you hold that you manage for your clients. And the general rule is like around, or the general, not rule, but the general amount is around 1%. So earning 1% for whatever it is you're doing with those assets. And then they can also charge a fee for planning. So they can earn money 3 different ways. That's fee-based. Then you have fee only. And those people, those advisors can charge for assets under management and earn a percentage off of that. And then they can also charge a fee for planning. So they have the assets under management. That's money that they have you move over so that they're managing it for you. And then they have the planning fees. So those are both planning fees. In the fee only space, then a lot of them are required to act as a fiduciary, which is in the client's best interest, right? A fee-based planner is only required to act under suitability, which means it has to be a suitable investment or suitable product for the client. Somebody that's commission only doesn't have any duty to the client. They're just selling a product. So you have the commission only, just selling a product, could be good for you, could not be good for you. It's hard to say. Then you have the fee-based, who are just making sure it's suitable for you, which is one type of way of making sure that it's okay. But then in the fee only space, you have the ones that are a true fiduciary acting in your best interest, but are earning money two ways, through planning fees or through AUM. They don't necessarily do both. Some just do one or the other, or some offer both. Then you actually have advice only, that do not take assets under management, that just do planning. You pay them a fee to do planning, and they are fiduciaries, and they don't help you. They don't make you move your money or earn money off of your money. They just help you with your accounts wherever they are and help you figure out how to invest them. So that's the different types. So I'm not saying that one or the other is better. I'm just saying, like, understand how your person is getting paid and what their duty is to you as their client.
Nice.
Yes, I like that, because some of the things you explained, I didn't know about it. So yeah, you're educating us too.
Yeah, I mean, that was very thorough. Thank you very much.
And so now the heartfelt thing that I want you to share, the reason why we have the Money Talk, Linda, is because our ultimate goal is to be able to change people's lives. And like today, and I'm sure you're more aware of it than we are, because you're actively doing this every day. But there are so many people that should be able to retire. They're not able to retire, or either they have retired and they had to go back to work. So our whole meaning for our podcast is to help people plan now so that they can have a healthy retirement. So I would like for you to explain to our listeners why it's so important to financially plan their lives.
Sure. So it's like you said, in planning for retirement and making sure that you have enough money. So using a financial planner and doing a plan helps you see how long your money is going to last. One of the biggest lessons that we start to learn even as children is like the longevity of money, like how long it lasts, right? If you save in your piggy bank and you're saving and you're saving and saving for a long time to save up for one thing, you get that one thing, and that one thing is just gone. Right. Mm-hmm. So that longevity of that money is not the same. And understanding how it's going to work when you start coming down that mountain is a big part of that. The consequences are, if you run out of money, are you asking your family members for help? Are you going, are you on Medicaid? Are you on, like, where are you living? How are you living? What does your circumstance look like? And the last thing we want to do is be a burden, most of us anyway, is be a burden on our families, right? Especially, if we have children and they're raising their children, and then they feel like a responsibility to us, like we're putting them under so much pressure. There's a lot of us, me included right now, that are in that sandwich generation, taking care of elderly parents as well as our own families, and et cetera. So it's important to have planning. And I don't even think we touched on estate planning here, but that's a big part of my process too. I even forgot to mention that. Making sure you have a will, a trust, your powers of attorney for healthcare and financial, if anything were to happen to you. That is like basic of financial planning. And I'm not a lawyer. I don't do that part, but that's one of the first things I ask my clients is, do you have that? And I want to be sure that they're getting that in place.
Oh, that was so good. Mm-hmm. So thank you. I appreciate that. Is there anything else you would want to add? Because I could just keep asking her questions from here until later.
Yeah. No, I'm good, actually.
Yes. And is there anything else that you would like to share that may be on your heart that can help someone turn their financial lives around? Because with your profession, you do have the power to where you can make a huge difference in somebody's life 10, 15 years from now. So if you have any words of wisdom that you would like to share, we welcome you to do that.
Sure. So the main thing I want to make, that the message I want to put out, is that financial planning is available to anyone, right? Whatever your financial circumstances are, there are resources out there for you. You'll hear, like, sometimes people say, I don't have enough money to go to a planner. You still need to plan. And not all planners have a minimum. So some planners will have, like, you have to have so much in assets in order for me to work with you, right? There are planners out there that don't have that. So just know that if you're looking for someone, your person is out there. Just keep looking until you find the right one, the one that fits you, that you have a good rapport with, that you feel comfortable with, that you feel like you're being heard, and that has a program that's available for you in your circumstances.
Okay, so I'm sure listening to you and the wisdom that you share, there's someone that's like, I would love to have someone like her. Can you tell people where you are and where you can function in if they want to reach out to you?
Sure. So my company is Visions Financial Planning, and it's Visions with an S on the end, FP, like financialplanning.com. So visionsfp.com. That's my website. That's where they can find me. What was the other thing you asked me? Sorry.
What do people have to be in a certain state before they can hire you?
Oh, yes, the state, the location, right. So I'm like, I knew there was something else you asked me, and I just totally lost my mind. So I'm based in Illinois, but I can work almost anywhere throughout the United States. So I can work in all states except for Louisiana and Texas right now. So if anybody is in those states, then I have to get licensed in those states before I can work with you. So that would be a delay. But other than that, I'm good to go. So feel free to reach out.
Thank you so much.
All right. Well, we really appreciate your time, Linda. Join us on the Money Talk today. You provided some great information to the audience. So we really appreciate that. Anything you have, honey?
I just want to say thank you so much. And you are definitely a life changer. And so keep doing what you're doing. Thank you so much for being here, being candid and being honest. We appreciate it so much. And we look forward to having you on the Money Talk again.
Yes.
You're welcome. And thank you for doing this, because it's a good service to the people of the world, for sure.
Oh, thank you so much, Linda. We'll see you next time.
Yep. Bye-bye.
Bye-bye. Conversation. I know that you enjoyed our conversation with Miss Linda. If you missed any of the content, please go back and take some notes. Again, the purpose of the Money Talk is to help you make better financial decisions so that later in your life you can have a better life and a better retirement. Thank you so much for watching the Money Talk, and we'll be back here the next time to talk about money.